Hello everyone, this is Fuge Zou, data scientist from RapidCanvas. Today I'm going to present to you a demo on a use case of corporate credit risk with an end-to-end solutions using RapidCanvas platform. There are three parts of my presentation today. First, I'm going to introduce the problem statement and the data, followed by exploratory data analysis and feature engineering. Then end up with model training and model prediction using RapidCanvas platform. So let's get started. First, the problem we are dealing today is the one application in the financial planning and analysis, short for FP&A. The problem we have here is how to use financial statement data, say income statement, balance sheet, and cash flow statement to predict the credit risk of a corporation. The data we use are financial statements and credit rating history from the companies that are listed in the publicly listed in the United States, including New York Stock Exchange and NASDAQ mainly. Here are some business contexts for this demo. You can see for the first part, it is the US corporate bond market, which has tripled its value for the past decades, especially after the Federal Reserve dropped the interest rate during the COVID time, right? Its market value is over $1.5 trillion now. So this is a huge market and very important financial assets for banks, institutions, and investors all over the world. And one fundamental problem to solve is whether the credit bond is its relationship with credit risk and its return, or we say yield, right? And you can say the second chart is basically showing you the credit risk of corporate bonds throughout the year. And you probably noticed a significant jump in the high-risk bond after 2016. So this chart only covers the pre-COVID time. So we're expecting that this trend will shift during and after the pandemic period. So again, this is from business background to help you understand our goal, right? What is it? The definition of risk here is inability of firms to repay financial obligation. Basically, it can be interpreted as a probability, right? And why this is important? Because credit risk is one of the fundamental problems to solve when investing or operating a corporate bond. And it is $1 trillion market. All the banks, financial institutions, and investors need such information to evaluate price and return for the investment decisions. And our goal is to build end-to-end machine learning and AI solutions, and which automatically for these companies to these problems that will help the decision makers to evaluate the risk versus bond price versus return. All the investors, employees, suppliers, and customers from financial institutions can benefit from this study. So next, here's a little bit more information. We just zoom into the detail, right, about the credit rating before we start into machine learning. Basically, there are three major rating agencies in the United States, which are world known, are Moody's, Standard & Poor's, and Fitch. They are super famous. So this table represents the credit rating from these rating agencies from the best rating on the top to the worst rating on the bottom. So we start from the lowest risk companies such as Microsoft, Apple, or ExxonMobil. They are probably all AAA rating or AA rating, right? They are the low risk, high grade ratings. And you move down from the list. So we have BBB or B rating, or C or D. With D is the worst, right? It means default. And the key takeaway here is that the boundaries between the BBB and BB rating is where we differentiate so-called investment grade bond versus speculative grade bond. Here, the investment grade bonds are lower risk and usually lower return, and speculative grade are higher risk and usually higher return. So the data source, again, we are from the public traded company in the United States, and our data input or data features are financial statements, such as income statement, balance sheet, and cash flow statement. And our target is whether this bond is an investment bond or a speculative grade bond. So here we are framing this problem as a binary classification for simplicity and for demo purposes. But in reality, you can also frame this as a regression problem. You can say, I'm giving the highest grade as 5 or highest rating as 5 and lowest rating as 0. So I'm just doing 0, 1, 2, 3, 4, 5. I can do a regression rating, just like you are rating a movie or something. But here for simplicity, we're just showing a binary classification. And this is still very, very applicable and practical and useful. So here, let's enough for this problem statement. Let's jump into the taking a detailed look at the data, right? So the data is basically a very big table. We spend time just mining all the data, not only the financial statements, but also all the rating agency, the credit history. So we are mapping the past. You can say there are over 17,000 records, and total investment grading are 3,300, and the year range is from the past 15 years, and total companies are 1,500 companies from the public listed companies. These are all the public information that you can get, but it requires lots of data mining process, right? So I just want to save you for the you don't have to know the detail, but we spend tremendous effort mining all the data from the internet, and you can see we have calculated all the features which I think are related to the credit risk of this of a corporate bond. There are about 40 features. So in this study, and you can say generally speaking, we are just say speculative grade bond are 0 and investment bond are 1. This is our label. I can say we have slightly more speculative bond than the investment grade bond. Like I said, the rating counts by credit rating are, you can say most of these are just BBB, BBB, A, and AA bond have the most rating. Remember, we have a line from BBB to BB. Above BBB, including BBB, is investment grade. Below BBB, BB, B, CCC, and CC are speculative grade rating. This is a correlation matrix, which is say our target is either 0 or 1, with 0 as speculative grade, 1 as investment grade, and these are all the features we use, right? IS stands for income statement. You can say the gross profit margin, EBITDA margin. So you can say which you can say lots of these red means they are highly correlated, right? For net income ratio versus probably net profit margin, or current ratio, right? There are some co-correlated feature we're gonna remove in the feature engineering part. But you can say this is overall correlation between the features, and you can also check individual financial metrics, right? This is a debt, right? The higher the debt is, the more likely it is like a speculative junk bond, right? The high yield bond, junk bond, speculative bond. But the lower the debt ratio, debt to equity ratio, debt to asset ratio, you will have a more likely to be a investment bond. And you can say net profit margin, this is the opposite, right? If you are a highly profitable company, you are likely to be investment grade. You are lower profit company, you are more like a speculative grade, right? High yield or junk bond or gross profit probably show you the same trend, right? These are the features that you can pick just to show you probably the drivers. What is the differentiator between speculative versus investment for later for machine learning. So this is just like a exploratory data analysis here. So once we finish this step, we put into our platform. You can see this is our platform showing you the end-to-end workflow. So everything is done inside our platform. You can say starting from general input the to load the data, right? We have income statement, balance sheet, cash flow statement. So these are the blue square means the data, and they go through this orange circle here, which is the process, right? We have credit rating, these financial statements goes into this process called merge and clean, and that will output is just one DF data frame merge data. And our train and test strategy here is that we're just split the data by time, right? Yeah, remember the data is from 2005 to 2021. So we're basically saying that everything before 2019 are train data, and everything after 2019, including the year of 2019, is our test data. So that will go through some feature engineering step, and you will end up with output of train data with feature selection, feature engineering. Then you will continue to model training, and you will generate the final results, right? This is a model, and we save the model in our artifact in the server side. So and if you have some new data, here we only show you a batch process that just like for simplicity. So basically we load all the test data just like it's a new data coming in, right? And we load the model to do the same feature engineering and to end up with the same test data with the same feature we use, and we try to load the model to make the prediction. So that will be our final prediction. So that will be the end-to-end workflow. So let me show you this model performance again. The model strategy is where, like I said, we have credit rating and financial data before 2019, right? We have 14,000 records just split by time, because I think this is more appropriate. And you can say this is our test data is our credit rating and financial data after 2019 as test data, right? We have 2,700. So model summary is that we have used AutoML workflow that give you the best results. Here the GBM gradient boosting tree have the AUC of 97%. This is from cross-validation score. So this is our accuracy, which is 97% accurate. And you have log loss, AUC, precision recall, and mean person class error, right? You can see very good model, very good good results from the training data. You can see the model performance from cross-validation score is almost 97%. But you can see when we apply that model to test data, that precision is actually dropped to 88%. Why? I think that I have a very good explanation. That is because after 2019, you know what happened, right? It is a pandemic. It is a COVID pandemic. And I think the corporate bond market, so you have the Federal Reserve just lower interest rate plus the pandemic. I think this is called probably concept drift, we have drift problem there. So that means we may keep training the model, including when we deploy the model, we're going to deploy that with the training data using the post 2019 data instead of doing this kind of split, right? But this is just for a demo, right? You can notice what is the train data, what is the test data, what is the results. And you can see the driver here. I think that is still valid. You can see this is a shapely plot basically showing you the model explain. Basically, you can say the most key important driver from top to bottom, right? The most important driver is, like I just showed in the exploratory data analysis, that's debt ratio. Debt ratio, you can say the lower the debt ratio is, the more, which means blue to the right, which means this is a negative driver. So the lower the debt ratio is, the more likelihood that is investment grade. The higher, the red means the positive driver. The higher the debt ratio is, which means the more likelihood that will be a junk bond or high yield bond, speculative bond. Same thing for operational cash flow, right? The red to the right is a positive driver. The red to the left is a negative driver. So red to the right means you have a higher operational cash flow sales ratio, you are more likely to be an investment grade bond, which makes sense, right? If your operation cash flow is very, very high compared to your sales, which means your business is very profitable, and your debt is very low, so which means your likelihood of being an investment grade is very high, right? Same thing for return on capital. If my return on capital is high, which is a positive driver, remember red to the right is a positive driver, right? It's a very positive driver for an investment grade bond. Same thing for net profit margin, right? If I'm a profit business, I'm most likely I'm a higher investment grade bond. Okay, so this is a Shapley plot, and also this feature importance also similar to Shapley plot, but that tells you the similar story, but it doesn't tell you whether it is a positive driver or negative driver. So, which this is a similar story here, and these are the data science specific metrics such as ROC curve, precision recall versus threshold, and false positive rate, right? Just if you are a data scientist, if you are not a data scientist, just ignore this. So last but not least, this is our corporate credit risk model prediction. Remember, once we have trained the model in our build process, we're gonna load the model. If the new data coming in, say for example, in 2023, you have some new ratings and new financial data coming in, and you are gonna predict, right? So you can load the model and try to do the real-time forecast. So this is a real-time forecast, right? Let's just use Apple as an example. Because Apple is a company we all know, right? It is probably the AAA rating. The target is yes, it's an investment bond rating, investment grade bond. And you can say, oh, this is the record of Apple, and the year is 2019, but just a showcase, right? This is in the test data. So you can say the model, first we can predict the model, just ignore this for now. This is Apple. So you can say the model predict 93%, that's a yes for investment grade, and this is a local model to explain this case, right? Let me just quickly go through that. This is so because Apple has a very high return on capital, has a very high net profit margin, has a very high operational cash flow, has very high operational cash flow to net income ratio, right? This means Apple has generating real operational cash. It is highly profitable, and it has lots of cash. So these are all the positive driver pointing to that is an investment bond. But Apple also has some debt, because Apple is such a strong company, it can take debt, just leverage make a best return on capital. I think return on equity, right? This is just Apple's strategy, but still Apple should be considered as one of the best company for investment, the safest investment, right? So this is means our predicted result is yes. The actual result is actually yes, right? Because this is like the test data, we still know the label, so we are correctly labeled that, right? So the next step is what if analysis. Basically, you are wondering, what if Apple's, this is like for like we are doing some sensitivity study, right? You can say this is what if Apple's debt ratio is super high? How will that change the results? You can say if we change the increase the debt ratio from 73% to 93%, I think the probability of an investment bond drop from 93% to drop a little bit, right? But if you say net profit margin is negative, right? What if Apple is doing a very poor job on just making money, right? So you can say immediately that results becomes no, right? You can say just by turning this knob, like net profit margin, you can basically fine tuning the model and do some what if and sensitivity analysis on which one is more of a key driver. Same thing for current ratio. If you say current ratio is super high or super low, and that will drive the results even further, right? You can see. So that basically concludes this demo. So thank you very much for watching. Bye bye.